Hello, everyone, and welcome to this edition of Portfolio Partners. Today we have David Gibb, who is the portfolio manager for Anchor Worldwide Flexible, and he's been the manager of that fund since its inception in 2013. He's done an amazing job beating the benchmark on every period. From inception, 5 years, 3 years, and this year, so 12 months. So we'll be hearing from David and his opinions on the performance and a little bit about the actual fund. So David, just so you know, has been in the industry since 1994. He's a BSc, a CA, and a CFA charter holder. So apart from the qualifications, he's also got the track record to show that he actually is a great fund manager. So welcome to the show, David.
Thank you, Jim.
So David, as you know, we have a short time to get you to tell us all about your fund. So we're going to start by just going into the most recent the performance statistics of the fund. Just getting that going here. Sorry, I had to went past the starting point. There we go. All right, David, would you like to talk about your performance since inception?
Yeah, thanks, Jim. I think, the thing to note, obviously, since inception, we've beaten our benchmark. But I think in the more recent years, the trend has improved. So, we've tended to do better over time. Obviously, the last 3 years have been exceptional. And the base, we had a big sell-off on the market 3 years ago. So the base was a little bit lower. But I like the trend, and I'd like to, obviously, I'd like that trend to continue. I think as you become more experienced, maybe you do make fewer mistakes over time. So that isn't one of the considerations. But the other thing is when there's, panic or greed in the market, I think you learn as you become more experienced to take bigger advantage of moments like that. But I think ultimately for me as the fund manager, what I would like for clients is to produce the sort of the best returns relative to my peers over the longer periods. And, we're not at the top yet over 10 years, but we certainly aim to get there.
Yeah. Well, David, you're certainly heading in that direction. Of course, when you become number one, that's a difficult spot to hold, isn't it?
Absolutely. There's only downside from there.
Yeah, yeah. But our clients will be happy with all the good performance that you achieve in getting there. So yeah, it's been great. As you know, we've more recently been investing quite a lot into your fund, and we've been very happy with the results we've been achieving. So thanks for that, David. So let's move on to the next slide, which is basically this some of the holdings that have contributed to this excellent performance.
Yeah, so it's interesting that that we look over 3 years, because if you go back 3 years ago, that was 2022 when there was quite a lot of panic in the market. Interest rates were on the way up, and stock markets had a very tough year that year. We went into that year with around a third of the fund in cash, and we had been struggling to find things to buy. So I think it was a very big year for us as fund managers there because we deployed a lot of cash during 2022. There were lots of new holdings. We introduced things like Netflix, um, Citigroup. There were a couple of holdings that we added to too. So coming back to that point I made a little bit earlier about taking advantage of extreme situations, buying when there's panic in the market. And I think we've been feeding off those good purchases for the last 3 years. So it's important to take advantage when the opportunity presents itself.
Indeed, and I think there was quite a bit of negativity around Netflix a few years ago and their profitability and maybe their ability to produce continually good content, but they bucked that concern and they seem to just keep growing. Yeah.
Yeah, there was a concern, with the COVID pandemic behind us that, people would stop some of their subscriptions to Netflix. And so the subscriber base stopped growing. They went through a few quarters where people were worried about the long-term growth of the business. But, it's a great management team and they got back on track. And now the revenue line is growing very nicely again.
Yeah. And the one that's contributed the most, which is quite an interesting choice because it's not in everyone's portfolio, GE Aerospace. Not to the extent that it's in your portfolio. So what drew your attention to that, David?
GE Aerospace, I mean, I had been a holder of GE for some time, and it hadn't always done well. And we went through a few CEO changes. But then Larry Culp joined as a CEO. He had been on the board, and he decided, well, firstly, he reduced the debt in the business, and then he decided to split it up. It's now called GE Aerospace. It used to be GE, and they split out their healthcare business and their power business. And he's just been the most phenomenal CEO. And there's been enormous value creation, with the split of GE into all these three different businesses.
Yeah. Well, it certainly paid off. So well done on that. Having the tenacity to hang in there, David. So let's now talk about your philosophy because sometimes when we talk to fund managers, it sounds very complicated. All this, how do you pick funds or how do you pick stocks and when to buy and when to sell? So what's your philosophy, David?
It can be very complicated, but I think it's important to try and keep it as simple as possible. And I mean, I think for me, there are two key principles that I'd like the clients to always remember is that I mean, the first of those is that, we don't want to lose money on any new investment. That really is the most important thing. It's difficult to make the money back. So don't lose money. In other words, don't overpay. There are lots of things that go with that statement. And then the other thing is when you find something that you like, and believe me, there are not many ideas that really stand out every year. So when you do find something that you like, you need to buy a lot of it.
Yeah.
So really have to back your views. So don't lose money and back your views. Those are very important, certainly in the way we run this fund. The other thing is to if things don't work, you need to do the housekeeping. Just clean them out, reduce the clutter, and let your best ideas compound over time.
So when you say that when you find something that you like and you need to buy a lot of it, does that mean that you will purchase much more than the index weighting of that stock?
Absolutely. So, if you do look at the top 10 holdings in this fund, I typically don't really care what the index weighting is. I just want to make sure that we can benefit properly from, a good idea. So in other words, if the share price doubles or triples, we need to see that in the performance numbers. So it needs to be big enough to count.
Well, that's how you beat the benchmark, isn't it, David? By having those far higher contribution to your overall gains. Yeah. Good. Well, that as we say, keeping it simple is a very hard thing to do, isn't it?
It is. It's easy to say, but you don't want to. You want to try and limit your choices too. So count out certain areas. If you don't know certain sectors well, you need to have a wide enough range of sectors that you can invest in, and then you build on the depth. And that means over time, your investment decisions will tend to get better because you're
Mm.
not always spreading yourself too thin.
Right. Well, one of the things you mentioned about your how the economy works and what influences you quite a bit, I think, is where the actual spending comes from. This chart that you have given us was a very interesting example of where the economic activity actually sits in an economy. Would you like to give us some further insight there, David?
Yeah, so here we're looking at the US economy.
Mm,
And I mean, the heading is that, obviously the rich are driving spending more than ever.
mm,
Um, and if you look at the top 10% of households, um, they account for, roughly 50% of all spending in the US economy. And
mm,
that's the highest it's been, certainly as far back as these records go, which is the late 1980s. So, if you go back a couple of decades, it was, in the high 30s, the
mm.
percentage of spend from this top 10%, but now it's around 50%. So I guess, we've been through a period of high inflation, and people have had to make choices, and that's really affected the working class and the middle class. They've had to be careful in the way they spend their money.
Yeah,
Um, but when you look at the top 10% of earners, their finances have never actually been in such good shape. And
yeah,
that's largely because of the assets that they own. Their house prices have continued to go up. Stock markets have been very strong. And, if they speculate in things like Bitcoin too, those prices have also
yeah,
done well.
yeah,
So there's a lot of confidence amongst the wealthy, and I guess people may have views: is this right? The spending, is it has it become too unequal? But
mm,
this is the reality, and I suppose it also means that if you mess with the confidence, if asset prices come under pressure, and they will obviously from time to time, what does that do to spending from the rich? So this is just something that we've obviously always got to bear in mind.
yeah. Well, these are sort of interesting facts that you have to have bear in mind when you're picking investments. Yeah. So, going into your holdings, David, you know, even though you talked about the USA, interesting to see that still your top holding is a Chinese internet company. Um, but would you like to talk us through the top 10 just very quickly? Yeah.
Yeah, I think what I'd like to say about the top 10 is, most people will recognize most of these names.
Mm,
Um, but I think what's important as a client for me is you want to look at these and say to yourself, will they disappear in a puff of smoke, right? Are
yeah.
these durable companies? And if you look at this list, I think probably with the exception of one of the banks, Citigroup, all the others are leaders in their field with
Mm,
big market shares and well-run businesses. Citigroup is more of a turnaround situation, and it does lead in certain aspects of its business, but generally these are durable market leaders. And I think that's the important thing, is that you want to feel that the bulk of your portfolio is has will be able to withstand tough economic conditions, as well as the good times that we've tended to be in more recently.
well, you make a very important point, which we try to um, emphasize quite often, is that when you're investing in a global portfolio, you're investing in companies that are huge, that aren't going to disappear no matter what actually happens. The worst that could potentially happen to some of them is they may merge into another business one day. But yeah, they're huge businesses, many of them bigger than small countries in their annual turnover.
Absolutely. And we do have a spread, as you referred to earlier, John, and we do have a spread across different countries. So there is a nice mix. And diversification, I think, is handy when certain countries are regarded as more expensive than other countries.
Yeah. All right, David. And then the country exposure that you have, is it quite different to what you might expect for your peers in the sector that you're in?
I would say so, yes. I mean, our US exposure is about 40% of the total value of the fund. And I think if you look at the benchmark weightings, or if you look at the market cap weightings of the various countries, out of a sort of world index, the US is a much higher weighting than that. So to be more, in the 60% sort of range. So
Mm.
we are lower there, and we do have a nice spread in Asia as well. So we have exposure in China and in Japan, and then obviously the US and the UK. So I like to have a mix. It's not a top-down thing that I impose on the portfolio, and it's really just a reflection of where we're finding the value. But it just so happens now that the US is probably less than what it was a couple of years ago.
Well, that's a very interesting stat. So just to then finalize, David, can you tell us a little bit about your outlook in the short term and the long term?
Yeah, so I think in the short term, exuberance is I think is the word out there. Although there's so much uncertainty in the world, there's certainly, when you look at asset prices, it's not really reflected in most asset prices. So there's a lot of speculative activity. I've mentioned Bitcoin. There's also there is an obsession with AI, and a lot of those companies, anyone involved in the AI field, their share prices are typically pretty high as this AI capex unfolds.
Mm.
So it's very different to the way it was in 2022 when there was a lot of panic. So I would say there's a lot more greed now than there certainly was 3 years ago. I think the fact that inflation is declining is a good thing. So it is a little bit sticky, and it's still not back to target, certainly in the US, but the trend is good. Obviously there is a tariff overhang that may keep it up. The quarterly corporate earnings are very strong, and that's been a big plus, particularly in the last 2 quarters, and it has driven share price performance. But overall, our view in the short term is that we feel it's a time to be defensive. And so we have quite a big cash weighting in the portfolio right now, and just slightly less than what we had at the end of 2021. So that is our mindset, is to be more defensive. If you look at the long term, there are certainly a couple of sectors that are offering pretty decent value, and we're finding, potential well, we have invested in consumer products. There are other areas like pharmaceuticals, anything to do with the housing sector, the restaurant industry. A lot of those are offering reasonable value. But I think the big sectors like technology, I would argue those are expensive. So we would look for lower returns from the overall market. But we still feel there are decent opportunities in some of those smaller sectors. So slightly lower returns going forward, but we will certainly do our best to find attractive opportunities that are underappreciated.
Well, thank you, David, and thank you to our clients for tuning into this edition of Portfolio Partners. We would like to say that any of your comments or feedback would be very important. But that's it for us today. Thanks very much, David.
Thank you, Jim.
Thanks and goodbye. Ciao.